So, if you're a founder trying to scale a Saas company, you know that proving your business is healthy is about way more than just showing a profit. We're going to break down two of the most critical metrics that investors look at to measure smart, sustainable growth: the burn multiple and the rule of 40.
All right, let's just jump right in. Every single startup founder is dealing with the same constant tension. You've got to spend money to grow, right? But are you spending it wisely, or are you just setting a pile of cash on fire with nothing to show for it? That's really the core question we're trying to answer here.
For a lot of high-growth, venture-backed companies, the name of the game isn't turning a profit in those early days. Not at all. It's about plowing every single dollar right back into the business to grab as much market share as you can. And that's exactly why the old-school financial metrics just don't tell the whole story.
Okay, first things first, we gotta clear something up because people mix these up all the time. You've definitely heard of burn rate. That's just about speed. It tells you how much money is flying out of your bank account. But the burn multiple, that's about efficiency. It tells you how well you're spending that money to actually make more money. One's about speed, the other's about efficiency. That's the big takeaway.
All right, so let's dig into that efficiency scorecard. The burn multiple is basically your report card on how efficiently you're using your capital. It really boils down to a single number that tells you, and more importantly your investors, how good you are at turning cold, hard cash into real growth.
So here's the magic of it. The burn multiple directly links the cash you're burning with the revenue you're actually adding. It answers a really simple but incredibly powerful question. How many dollars did you have to burn to earn just one new dollar of annual recurring revenue? And you know what? The math is actually super simple. First, you figure out your net burn over a certain period, let's say a quarter. That's basically all the cash that went out the door minus what came in. So in this case, that's $1.2 million. Then you find your net new ARR for that same quarter. That's all the new subscription money you brought in, and super important, you have to subtract any revenue you lost from customers churning. Here, it's $600,000. Then you just divide your burn by your new ARR. So $1.2 million divided by 600K gives you a burn multiple of 2.0x. Simple. That means for every new dollar of recurring revenue, this company had to spend $2.
So you get a 2.0x. What does that even mean? Is it good? Bad? Well, investor David Sachs popularized these benchmarks that kind of give you a grade. If your multiple is under 1x, that is amazing. You're basically printing money. 1 to 1.5 is great. Our 2.0x example falls into good, but it's a little flag that says, hey, we could probably tighten things up a bit. But once you get over 3.0x, yeah, that's kind of the danger zone. That's when your growth starts to look really expensive and maybe unsustainable.
But, and this is a huge but, these numbers are not set in stone. The expectations for what's good totally change as your company gets bigger. For a tiny company, less than $1 million in ARR, it's actually pretty normal to have a high burn multiple, maybe around 3.4x. Because let's be real, you're still just trying to figure things out and find that product market fit. But as you scale up past 5 million and then 50 million, investors expect to see that number drop a lot. It shows you've built a real efficient growth machine.
All right, so that's efficiency. But that's only one side of the coin. Now we've got to talk about the balancing act. This is the other critical metric that investors are always watching, the rule of 40.
This one's a classic. The rule of 40 is like a really quick, back-of-the-napkin gut check for a company's health. The idea is simple. Take your revenue growth rate, add your profit margin, and if the two together are 40% or more, you're likely in a good, sustainable spot.
And yeah, the calculation is just as easy as it sounds. You just take your annual growth percentage and add it to your profit margin percentage. Now for profit, you'll often hear people use the term EBDI. Don't let the acronym scare you. It's just a way to look at your company's core operational profit, stripping out all the accounting noise. Add them together and see if you hit that magic number of 40. And this is what makes the rule of 40 so smart. It shows there's more than one way to win. Look at these two companies. Company A is in total hyper-growth mode, growing at 55%. But they're burning cash with a negative 15% margin. Then you've got Company B, way more mature and stable. They're only growing at 10%, but they're throwing off a nice 30% profit. See? Totally different strategies, but they both hit that magic number of 40. And in the eyes of an investor, both can be seen as healthy.
Now, I got to give you a really important heads up here. The rule of 40, it's really meant for more mature companies. Think over $1 million in ARR. If you're super early, like just getting started, forget about this for now. Your one and only job is finding product market fit. And it's totally fine. In fact, it's expected that you'll be way below that 40% mark.
So, okay, why all this obsession with these two numbers? Because this isn't just for your internal spreadsheets. This is a huge part of the story you're going to tell investors when you're out there trying to raise money or maybe even sell the company one day.
I mean, listen to this quote from Ben Murray, the Saas CFO. He just nails it. For investors, the burn multiple is the single best indicator of efficiency. A good, improving burn multiple shows them you're not just throwing their money into a bonfire. It gives them the confidence that you know how to turn their investment into scalable, sustainable growth.
Okay, so let's say your numbers aren't looking so hot. What do you actually do about it? Well, it really boils down to two levers. You can either make more money or you can spend less money. Simple, right? To boost your revenue, you could look at your pricing. I mean, are you charging enough? Or focus on keeping the customers you already have. Remember, it's way cheaper to keep a customer happy than to find a new one. And to cut your burn, it's all about making your sales and marketing smarter and making sure every person you hire is directly contributing to growing the business.
Okay, but before we finish up, I have to give you a pretty serious word of warning. These metrics are awesome, they're super useful, but they are not perfect, and they can absolutely be manipulated. It really makes you ask, can you actually trust the numbers you're being shown? And this is where you, as a founder or an investor, have to put on your detective hat and be a little bit skeptical. Here's the thing you absolutely have to understand. Both of these metrics, they're what's called non-GAAP. That just means there are no official standardized accounting rules for how to calculate them. And that flexibility is great for getting a real operational view, but it can also be used to, let's say, make things look a little better than they really are.
So there's a really fine line here between what's okay and what's, well, kind of sketchy. It's totally fine to use things like EBITDA to see how the core business is doing. But you cross that line when you start cherry-picking what costs to exclude just to pump up your profit numbers and hide the real expenses.
Let me give you a classic example. Say a company's whole strategy is just buying up other smaller companies. They might exclude all the one-time costs of doing those deals from their profit calculation. So they get to brag about all this new revenue from the company they bought, but they conveniently hide how much it actually cost them to get it. That is a massive red flag.
And look, that really gets to the heart of it. Mastering these metrics isn't some game to find the most attractive number you can slap on a pitch deck. It's about having an honest conversation with yourself and your team about what's really going on in your business, the good, the bad, and everything in between.
At the end of the day, your metrics tell a story. They tell a story about how disciplined you are, how healthy your business is, and what its future potential looks like. So the real question isn't just what's my number, it's am I telling the whole truth?